Satish Ramanathan joins us, market analyst. Satish, markets are really reacting to a lot of news. There is a buzz of a merger between Pfizer and Wyeth, and then there is bad news which surely has come for the sugar sector, as nearly 70% of UP-based sugar companies, they have decided to shut down.
Right. I mean, though these news really doesn't change the broader trend in the markets, we think that markets need to consolidate here for some time before the next leg up actually takes place. I think we have rallied pretty hard over the past few months, and we have to take a breather for some time. Otherwise, we would be in for a sharper correction.
Satish, fair point. Currently, global markets are in a risk-on mode, and clearly cheap money is chasing asset prices. But do you think the difference in this current leg of risk-on rally versus previous leg of risk-on rally is that in this leg of risk-on rally, market participation is strong, macro numbers are looking stable, and for the first time we've got more earning upgrades and less number of earning downgrades?
I think that's one of the reasons why the market itself has rallied. So I think it's not something which will justify a further market rally. I think the fact that the bad news is diminishing and there's no good news, but there's no bad news as well, is something which is what has resulted in this market rallying so hard. So I think we just need to be a little more cautious at this point in time.
Satish, the market seems to be pretty lackluster with the volumes pretty much anemic the last couple of trading sessions. Do you think the next big trigger for the market is going to come in only on December 8th when we'll have the state election outcome come by?
I think December 8th may be one of the triggers that we are looking for, but we need to bear in mind that December is a weak month for FIIs. Most of the rally in this market has been driven by FIIs. And come January, we are going to have some people worrying about the elections, national elections as well. So I think we need to just wait and watch. Really, I don't think we are going to see a fresh big rally in December unless the money flow is very, very brisk or active.
Satish, technology stock surely has fueled the market rally this year, but post numbers, most of the technology stocks, with the exception of Infosys, they've done precious little. Why is that happening? And B, after the recent run-up, are you also tempted to book some profits there?
I think the rally has been driven by the fact that the currency has been fairly stable at 62, 63. It hasn't come back below 60. So to that extent, people now see some longer term visibility in tech on the currency front. The second aspect that we need to bear in mind is that the volume growth in IT will probably start coming towards the end of the year and beginning of next year, rather than because US recovery is nascent right now. So a lot of expectation and hope on that score as well. I think going by the fact that IT is a free cash flow generating business, has still got the currency in its favor, we should be still holding on to IT stocks, though probably booking profits at this point may make sense as well.
What's your view on the banking pack then, Satish? What is it that you like or dislike out of the lot?
The PSU banks have had a short rally, and I think we should be trading in and out into PSU banks. Even amongst PSU banks, I like fairly better quality names in that where the NPL situation is not as bad. And there, I think Indian Bank seems to score pretty highly there. And in terms of the other large cap PSU banks, probably Bank of Baroda also makes some sense to trade in and out. So we really have to have a trading strategy among PSU banks there.
Satish, if I look at Eastern markets like Japan, BOJ is committed to print more money. If I look at Western markets like US and Europe, US Fed and ECB is also committed to follow a loose monetary policy. So how does one invest in this kind of a liquidity fuel environment where surely for the moment, liquidity is trumping all fundamental concerns?
I think one of the reasons they are trying to chase liquidity is that they want to ensure that there is money available for businesses to grow. But that's hardly the issue there. Businesses are cash rich. Their debt to EBITDA levels have dropped precipitously. And even people are leveraging their balance sheets. So really the issue is that the governments have debt, people are reducing debt, and corporates don't have debt. So in such a situation, to anticipate growth coming through in the real economy is seeming a little more distant than what we thought it would be. One. The second aspect is that this entire game is going to be of asset prices and waiting for the next bubble to happen, unless the central banks start tightening sooner rather than later. So I think the entire market is gearing itself up for another bubble. It could be in equity assets or it could be in some other asset class. But I think the situation is ripe for a bubble to form.
What have you made of the recent rally that we've seen in the metals plays, especially with names like Tata Steel, which have a European exposure?
I think steel has surprised everybody on the positive side. One is that higher volumes have been sold. The second aspect is that prices aren't falling even though China is slowing down as much as feared. And the third aspect is that there is a marginal improvement in Europe as well as in US. So the commentary from the Western markets have been much more positive than anticipated, be it ArcelorMittal or Nucor or any of the other steel companies. So I think steel, even aluminium, have given a positive surprise much to market expectations. And I think steel has some legs to run here. It could still go up further because of the buoyant market, fundamental market.
Satish, would you be a buyer in any of these sugar stocks, because now they are available at option value? Whatever could go wrong has gone wrong for this sector, and incrementally now things can only improve.
I think global sugar prices are not very strong. They are heading down. That's one. And the sugar companies actually make more money out of their alcohol sales and power sales rather than sugar sales. So depending on which company has the highest alcohol and power sales, I would be looking at some of them from a tactical perspective. But fundamentally, I don't appreciate sugar stocks because it's finally a commodity with low value add.
What's the view, Satish, then on the auto pack? We've been seeing trading rallies in bits and starts in Maruti, and of course Tata Motors has been a strong performer.
In the auto space, I think the numbers have surprised positively. The rate of decline has not been very strong. It has actually been lower than what most people expected. And the industry will start picking up probably post-March because the base effect starts playing out then. So in the case of Maruti and the two-wheeler stocks, I think they have actually done better than what most people expected. In the case of commercial vehicles, Tata Motors, I think the domestic industry is in a bad shape, but JLR has really helped them show very good numbers.
Satish, I've got a list ready with me. Last time you flagged off 3 names for our viewers: BHEL, Cipla and L&T. After the recent run-up, are you still a buyer in BHEL, Cipla and L&T?
Not BHEL and Cipla. I would still back L&T. I also mentioned Inox, which is a theatre company. I would still hold that, and I would bet on some of the auto names such as Maruti for the next trading.
Maruti is not at 1300, it is at 1700. It is trading at a P multiple of about 14-15 times. Would you still be a buyer there?
I think the earnings momentum can surprise there.